Once again, we're in the place to be. Welcome back to In the Black. Like the video. Help me grow the channel. And with that being said, let's jump right into it. If there were ever such a thing as a mystery, it could be argued that impermanent loss would be shrouded in that mystery. The subject is steeped in misconceptions, overanalysis, and fear, when the overwhelming truth is that it's not always so complicated when you break it down. Now, impermanent loss is the potential profit lost as a result of providing your tokens or coins to be used in liquidity pools by traders. And liquidity pools exist in order to assist traders and enthusiasts in moving in and out of different cryptocurrencies, chains, and platforms. There's a risk and reward reality on the part of both the trader and the liquidity provider. In other words, when you voluntarily provide access to traders to utilize the liquidity in the form of a pair of your coins or tokens, there is the potential of missing out on profits that would have been realized if you had simply held the tokens separately. Now, in the spirit of the Animal Farm, we are going to create a fictitious token out of thin air in order to provide an example of what impermanent loss is. So we're going to create the horse token. And let's use the horse BUSD LP token for an example of what impermanent loss looks like. So you invest $1,000 worth of BUSD in this LP token by pairing $500 worth of BUSD for horse token. This allows you to have $500 worth of BUSD and $500 worth of horse token paired as liquidity pool tokens. Now, since it costs 78 BUSD per horse, you are able to obtain 6.4 horse tokens for your 500 BUSD. Now, everything is even at this point until the horse token begins to become very popular and it increases dramatically in price. Now, it's in demand. First comes $90, then $100, $120, and all the way up to $150.54. Now, this is more than double the value of the horse token when you paired it with the BUSD. That's pretty cool, huh? Well, considering that you originally had 6.41 horse tokens paired with 500 BUSD, your present holdings have changed just a bit. Because of the increase in the value of the horse token, the 50-50 ratio in dollar value of the two tokens must stay at equilibrium for the LP token to work. Now, since your initial 6.41 horse tokens experienced a 93% rise in price, you must have more BUSD and less horse to keep them at equilibrium. You will now have 4.61 horse tokens, which are worth a total of 694.62 BUSD. And paired with that, you have 694.62 BUSD for a total BUSD value of 1,389.24 BUSD between the two tokens. It seems good because you have gained 38.9% on the initial 1,000 BUSD you invested in LP tokens. However, if you had just held the 500 BUSD and the 6.41 horse tokens in lieu of pairing them as LP tokens, you would have a total of 1,465 BUSD in value. As the price rise to 150.54 would have substantially increased the value of your holdings. In other words, your impermanent loss is 5%. This is impermanent loss. It is an unrealized loss in value that does not become real until the LP tokens are sold. Now note that 3 scenarios can play out before you were to sell. The price of the horse returns to its original price of around $78 or possibly lower. The price of the horse goes up even higher, resulting in a higher percentage of impermanent loss. Or the price of BUSD experienced volatility as well, causing more impermanent loss. This is where people get excited. They become panicked and avoid investing in LP tokens as they make snap judgments about the potential for impermanent loss. Firstly, in the animal farm, you don't ever have to sell your LP tokens. I certainly do not plan on it, ever. This is why I don't worry about impermanent loss when it pertains to the animal farm platform. Simply put, you are earning gains as an investor for lending out your LP tokens. If we look at our scenario a bit deeper, you'll see that the picture looks a little bit different. What was left out of the first explanation is that those original 6.41 horse tokens and 500 BUSD were paired as an LP token and staked in the horse BUSD farm, earning a yield of 0.39% daily. Now this translates to roughly 0.026 horses per day, which is equivalent to 3.94 BUSD every single day. That's about $4 or so every single day. This means every month that LP token staked in the farm is earning a yield of 0.789 horses per month, which is equivalent to 118 BUSD per month. Now here lies the difference and why impermanent loss is not something to be concerned about in this particular situation. Every month, that means you'd be earning 118 BUSD, which is more than the 75.76 BUSD that you would be forfeiting as impermanent loss as opposed to holding the tokens separately. And after 3 months, you would have accumulated 354 BUSD. And after 9 months, you'd reach more than 1,000 in BUSD if prices stay similar. However, the beauty is that no matter the price of horse, you'll earn the equivalent amount of BUSD every day, every week, and every month. Now here are some things to take note of. Impermanent loss only becomes permanent once you sell your tokens. If you don't ever sell your tokens, impermanent loss means absolutely nothing. And if you were earning rewards, it means even less. Number 2, the value of your LP tokens is different from the price of your separate tokens. There's the value of the LP token itself as it is paired. There's the value of the first token, and there's the value of the second token. We have different tokens with differing values. In the example that we used, we have BUSD, which has a value all by itself and has unique utility. We have the horse token, which has a value all by itself. And then we have the two paired together as an LP token, which has a totally different value. So please don't consider the 3 tokens to be all the same. Number 3, earning passive income trumps positive price action. Now, don't get me wrong. Positive price action is a great thing, and it's something that gets people pretty high in the crypto world. However, I would take earning passive income regularly over a long period of time than to have crazy positive price action over a short period of time. Simply put, passive income is something that can be sustained over a long period of time, while positive price action will tire out eventually. If it's of parabolic proportions, it's going to fizzle out a lot faster than a steady climb. But we all know by now, if we're in crypto for any length of time, that positive price action doesn't last forever. So in other words, long-term dividends trumps short-term gains. Number 4, you hold tokens and LP tokens for different reasons and or strategies. Your strategies are going to differ. Many people hold LP tokens in order to get a yield in other tokens that they are interested in. And people hold certain tokens or coins because they have a strategy of hodling, or they have a strategy of lending, or they have a strategy of trading. So it depends on which tokens or which coins we're talking about, but remember that they all have different reasons to be held. And you can employ your own strategies as you see fit. Now, this information that I've given is not to say that impermanent loss does not happen and is never a big deal. Now, it can be a troublesome issue on some platforms, but in my opinion, The animal farm especially is built in a way that encourages investors to keep their assets and earn from them without having to sell. Don't forget to like the video. Of course, it's up to you to do your own investigation and study on the subject of impermanent loss. You get to decide what's best. But I hope this video gives you a jump start in your understanding of impermanent loss. What do you think? What do you think about impermanent loss as a possible consequence of pairing tokens for LP tokens? What would be your approach regarding LPs on the animal farm? Let me know in the comments. I'd love to hear from you. And as always, stay smart and stay in the black.